Hey, good morning, guys, and welcome to another episode. All right, so today, by now, you guys should have at least completed practicing on your demo account. You should now have gone through the functions of the platform, be able to draw your lines, your vertical lines, and your horizontal lines, and also be able to buy, sell trades, and also use the pending orders. Now, what we're looking at today is I just placed a trade on my demo account, but I've also done that on my live account. And I want to show you guys something here before I move forward. We're going into this website, www.mql5.com. This is where I track my trades, or one of the third party websites that I use to track my trades. And then you can see on my live account basically what's going on here. So currently, we started with $2,500 in the month of January, like around the 9th of January. And to date, I am actually up 7.85%. Now, if you also notice, we did 44 trades, no losses. My best trade is at $15.50, and currently gross profit is at $196.21. Now, if we scroll down to my history, here you will see all my trades that were taken since the beginning of the account. All right, so we have to date, which is the 27th of January 2017. Let's go back to the beginning here, and we have balance 2,500. And here we had all the trades taking place coming forward. So this is just a good way of tracking your performance, guys. And there's another website that I use, which is myfxbook.com, which I will walk you guys through placing trades with that. Sorry, setting up your account with that website. And again, what that does is that it enables you to track your performance. It gives you statistics regarding your performance as you trade. All right, so here, as I said, I placed a trade. We're up $22, $21, $22, fluctuating. Once it gets to this red line, then I should be out in profit. And this is regarding my Euro strategy, my scalping strategy. And of course, in the last module, I will actually explain how this strategy works in more detail. All right, so let's get in with it here. All right, so the more I work with the market, the more it becomes apparent that prices are determined by one thing and one thing only, and that is people's changing attitude towards the emerging fundamentals. In other words, prices are determined by psychology, which I mentioned, yes, which I mentioned in my first lesson. The great technicians of the 1940s, which was Garfield Drew, once wrote, "Stocks don't sell what they're worth, but for what people think they're worth." If it weren't for the fact that these changing attitudes move in trends and that prices tend to perpetuate, market prices would be nothing more than random event, which means for you and myself, we would be out of business. Now, a classic example of changing attitudes that affected prices developed in the 1970s and early 80s. In 1973, a group of stocks known as the Nifty 50 peaked after a phenomenal rise during the 1960s. These were known as the trades as one decision stocks because their earnings went up every single year, and so did their prices. Now, people actually came to the conclusion that there was only one decision to make where these stocks were concerned, and that was simply just to buy. So these stocks included such growth names of the time like Kodak, Xerox, McDonald, IBM. During 1973 and 74, they declined substantially in price, along with the rest of the market. Over the course of the 9 years or so, the earnings for the group as a whole continued to rise, but the index did not make a new post 1973 high until 9 years later. Thus, we arrive at a situation where prices bear no reality to the earnings trend. Perhaps prices were too high in 1973 relative to the earnings, perhaps they were not. And they should have continued rising throughout the 1970s as earnings rose. Who knows? And who really cares? Technicians would say who actually cares and why. Because technical analysis assumes that the changing attitudes towards the emerging fundamentals are reflected in price action as displayed in our charts. The bottom line is technician does not have to know the reason why. He merely observes the conditions and takes the necessary actions. So when we're looking at price action, we're basically looking at a reflection of the economy overall. Now, one thing we need to remember in Forex is history repeats, but never exactly. And as price approaches a turning point, people react in roughly the same way. So, if we're looking at a chart, or we're looking at this chart here, and we're seeing this level of resistance in the market. Now, notice what happens. Price rallied up, then got rejected. Price rallied up, got rejected. Price rallied up, got rejected. Price rallied up one last time and got rejected again. So this is where traders um, sees trading opportunities at all times. So the market actually remembers that every single time price got into this level, price got rejected. It got into this level, it got rejected. It got into this level, it got rejected. Until finally it broke to the downside. Now, it is this similarity, it is this similarity behavior that shows up in identifiable price action or price patterns. And that is the subject of our little course here. Later on, we will classify these various formations, establish their reliability, and explain how they can be used as a basis for trading. Now, technical analysis defined. Now, at the onset, or I'm sorry, at the outset, it's very important to understand that technical analysis is an art form. Indeed, I define it as the art of identifying a trend reversal at a relatively early stage and riding on the trend until the weight of the evidence shows or proves that the trend has reversed. You have probably noticed that I've emphasized on the words weight of evidence. This is because price patterns should be looked on as an indicator in a weight of evidence approach. In other words, we should not look at price patterns in isolation, but consider them in conjunction with other indicators. Over the years, technicians have developed literally thousands of indicators, so it's obviously impossible to follow them all. By weight of the evidence, quote unquote, I mean 4 or 5 indicators that the user feels comfortable with. For me personally, I just simply use one. And I also use my resistance and support lines. So right now, you might be asking yourself, what does he mean by indicators? Well, I mean oscillators such as your RSI, your stochastic, your MACD, and so on. And we can find those indicators here by going to Insert, Indicators. We can scroll down to Trend. We can find trending indicators such as your average directional moving index, your Bollinger Bands, your moving averages. Here in oscillators, you can find your average true range, your MACD, momentum indicators, and so forth. So inside here, you'll see all the indicators available to you by this broker. All right. Now, other approaches include Elliott, Gann, or Wyckoff method. Now, a lot of you guys may not understand these terminologies or the names that I just mentioned. Anyway, still others rely on cycles, volume, or trend following indicators such as moving averages and trend lines, as I just showed you. Price patterns are therefore one indicator in the weight of the evidence approach. I strongly believe that they should not be used in isolation, but as I said, but rather should be used in conjunction with several of these other indicators which you feel more comfortable with. Price patterns should not be used blindly. They should be interpreted and applied with a full understanding of the underlying psychology that gives rise to their development. If you understand roughly how and why they work, you will be in a better position to interpret them in difficult situations. Now we're going to look at what is a trend. In my view, a trend is a period in which a price moves in an irregular but persistent direction. There will be a lot said on the subject of trends in our next few modules. But for now, all we need to know is that there are various classes depending upon the time frame under consideration. For example, a 60-minute chart will reflect very short trends, and a monthly bar or a monthly chart will reflect trends of much greater duration lasting for years. However, the principles of interpretation are identical when it comes to discussing trends. All right, so let's get into some slides. All right, so here we go. All right, three introductory concepts regarding price movements. All right, now before we proceed to a discussion of price patterns themselves, it's important for us to lay the groundwork for describing a few introductory concepts. By doing so, it's possible to obtain a firmer foundation and a better understanding of how the market actually works, and we will then be able or we'll be in a better position to interpret and apply price patterns to a more or for a more profitable trading and investing. So, this session will describe the importance and implications of time frames and trends. It will conclude with a discussion of peaks and trough analysis. And in the end, you will have a clear picture as to what we're discussing here. All right. Now, as I said before, the principles of technical analysis can be applied to any time frame, from your 1 minute candlestick to your weekly and monthly charts. So, again, as we discussed in our first session, these are our time frames. So we have our monthly time frame, weekly, daily, 4 hour, 1 hour time frame, all the way down to our 1 minute time frame. All right. Now, a trend is a period in which price moves in an irregular but persistent direction and is a time measurement of the direction in price levels. So, the primary trend revolves around the business cycle, which extends for approximately 3.6 years from trough to trough. Rising and falling primary trends will last basically 1 to 2 years. So when we're looking at a trend, and let's look at this monthly time frame, and let's shrink in from trough or to trough all the way back down to here. Notice this was from 2002. Now we're in 2016, and so far price has not gotten into this level just yet. So we actually say estimated 2 to 3 years. However, based off price action, based off the currency itself, it can last much longer time or shorter time period. All right, so what we're looking at here is your primary trend. Now, for us, I'm going to simplify this a little bit. Now, for us retail traders, our primary trend is basically our daily time frame. So we tend to stick to the D chart, the D1 chart, which is our daily chart. So this is actually telling us what is going on a day by day basis. So we will actually use, for the purpose of this presentation, we will use our primary trend as our daily time frame. So this green line that we're seeing here is our daily trend. So our daily trend is considered to be our primary trend, and this is a trend we want to follow at all times. So our primary trend will last anywhere from 9 months to 2 years. So at this point, we want to find out exactly which direction the daily time frame is trading for us to get a better idea as to where we're planning on trading in the market. All right, so let's look now at our intermediate trend. Now, our intermediate trend is basically our 4 hour chart. Now, notice what's going on here. With our daily chart, we're basically in a downtrend, right? But on our 4 hour chart, we are technically in an uptrend. So, at this point, we know that prices does not move in a straight line, and therefore, our 4 hour chart will sometimes move counter to that of our larger time frame or our primary trend. So, there are going to be times when we're going to be seeing an uptrend in our larger time frame, and this pullback here is just a minor retracement of this larger move. But on your smaller time frame, this is what you're going to be seeing. So you're just seeing a more magnified version of your smaller time frame, but on your larger time frame, it's just a minor pullback of your larger trend to the upside. So your forward time frame will eventually and will always move counter to your primary trend, but overall it will tend to move back in the same direction in the end. Now, moving over to our short-term trend. Now, our short-term trend is that of our 1 hour time frame, or we can even look down to our 15-minute time frame. So, your short-term trend, which is represented by this dotted line here, will move counter to your 4 hour time frame and also to your larger time frame, which is your primary trend. Now, this time frame is prone to volatility. So any little movements in the market, you're going to see that reaction a lot faster on your smaller time frame than you'll actually see on your primary trend, and sometimes even on your 4 hour time frame. So basically, when we're looking to do intraday trades, we're going to be looking at our short-term time frame, which is mainly our 1 hour chart and also our 15-minute chart. And even so, for some traders, they will go as low as their 5 minute time frame or 1 minute time frame overall. Now, how do we actually identify trends? Now, a trend consists typically of a series of higher highs and higher lows. And in a downtrend, we're looking at series of lower highs and lower lows. So as the market rallies, that's a rally, that's a pullback. That's a rally, that's a pullback. That's a rally, that's a pullback. So technically, to identify a trend, what we're looking for is a series of higher highs and higher lows. So this actually represents an uptrend. Now, a downtrend is represented by a series of lower highs and lower lows in the market. So as the market continues trending downwards, we are now seeing where the market has made a high here, a lower high, lower low, lower high, lower low, lower high, lower low. So this actually tells us that sellers are in charge of the market because sellers are pushing price downwards while buyers try to push price upwards. So once we see a series of higher highs and higher lows, we're in an uptrend. Once we see a series of lower highs and lower lows, we're now in a downtrend. Now, peak and trough reversals. Now, as we say, we know the market does not move in a straight line, and the market will and the market will actually move in waves. So, let's take a look at what's going on here. So, as the market continues to rally, we're seeing a series of higher highs and higher lows, right? Now, as price gets into a level of resistance or hits a ceiling, we realize now that instead of the market making a higher high, it actually stopped short of that top right here. And then the market started making a lower low. So therefore, the trend is no longer trending upwards because now we just broke this low point, and therefore there's a possibility at this point that the market could be reversing or actually retracing into a deeper depth before actually going higher, which we will discuss later on. So once we get a break of this area here of A, it simply means that okay, here's an heads up. we could now be seeing a reversal in the market. So now we're going to be looking to trade to the downside. And of course, we use that price action signal in conjunction with other indicators, as I mentioned earlier. Now, as price gets to a level of support or gets to a flooring, and remember what I mentioned, guys, that your support and that the market repeats itself, right? The market repeats itself. Therefore, the fact that price got down into this level of support, buyers who bought here remember that, hey, I made money going up on this level, on this trend. So now I'm going to get into the market here and try making money going up once more. So that's where we get those turning points in the market once price hits a level of resistance and also hits a level of support in the market. All right, so let's break it down a tad bit. All right, so as the market rallies, and then we're identifying a series of higher highs and higher lows in the market. So as that happens, look what happens here. We're actually in a trend, right? This is actually a pattern going upwards. Now what happened here? The pattern failed. Now we don't have a pattern going higher, making higher highs and higher lows anymore. Now we have a pattern that that broke out of its pattern and now started to trend into the downside. So what we as traders do is that we look for these clues in the market that will tell us that, hey, the momentum to the upside is no longer there, and there's a possibility now that we're going to see a reversal. So this basically is where you decide how to actually execute your trades to go long or to go short in the market. So in this situation, we see the market rallied back upwards. Try to retest these highs, failed, and then created a new low here, breaking this Y point. So now we're seeing a series of high, lower low, lower low here. So on a pullback, that becomes now your lower high. And then we're expecting the market to continue going downwards. Now, one thing to keep in mind when we see a price pattern like this is that once price gets into this level, two things can happen, or a few things can happen. One, we can see the market actually take off and move upwards once more. So basically, what happens here is that the market gained momentum. Once price broke this level, the market gained momentum and started shooting higher. And this is why your stop loss is so important, because your stop loss enables you to get out of your trades in the event your trade goes against you. So we need to keep our stop loss, and also depending on the strategies that we use, it's important to use your stop losses. All right. Now here on a downtrend, so we looked at an uptrend, sorry, we looked at a downtrend. Now we're going to look at the trend going upwards. So as the market falls, creating lower highs and lower lows in the market then eventually breaks to the upside here. So once we see this break of this resistance level, then basically our antennas go off to say, okay, now I'm going to look to trade this to go long. And perfect example of that is in this euro trade right here. So we're actually on a 15-minute time frame. And look what happens. Price was trending downwards. Price rallied, hit that level of resistance, came back down, and was basically moving sideways. Price actually came down to this level of support and got rejected once more. Why? Because market has memory. Then price actually broke outside of that level of resistance, boom, to the upside, pulls back some more, and then rallying upwards. So now we're basically seeing the same thing happening as we saw on the slides, where price came down, then eventually price broke back above that level of resistance here, and then started trending higher. So this actually shows us that the trend to the downside is getting weaker, and now we're seeing a possible turn in the market. And this is basically what we look for, guys. We look for clean price movements at all times. All right, so let's get back to the charts or to the slides. All right, so in summary, the principles of technical analysis can be applied equally to any time frame. Now, remember this, the longer the time frame, the greater the significance of any technical signals. A number of different trends simultaneously influence the price level of any market. Your primary, intermediate, and short term trends are most important. Peak and trough progression is the most basic trend identification technique and is the central building block of any price pattern analysis. All right, so let's break this down a little. Now, the principles of technical analysis can be applied equally on any time frame. So, if we go back to our charts, we're looking at a 15-minute time frame here, and we're seeing the market making lower highs and lower lows until it turned. If we go to a 1 hour chart, we see where the market now making, let me get this. Now we see where the market's making higher highs and higher lows until the market turns. If we go to a daily chart, we see where the market making lower highs. Let's start from here. Lower highs, lower lows. Oops, drew that wrong. Until the market now turns. So the same pattern can be seen on all time frames. Now the difference is, as I mentioned earlier, the longer the time frame, the greater the significance of any technical analysis. So we're going to be seeing these patterns on your 1 minute charts, your 5 minute charts, your 15-minute charts. But how valid these patterns are or these signals are depends on your time frame.